Good day. My name is Rossouw and I'm a portfolio manager with Adviceworx Private Client Securities. I'd like to spend the next quarter of an hour talking to you about the global COVID-19 pandemic and the impact that it's having on investment markets. I'd also like to share some thoughts with you on how Adviceworx sees the way forward. This week saw several governments suspend the use of the AstraZeneca COVID vaccine after some recipients subsequently developed blood clots. The World Health Organization has since endorsed the vaccine and pointed out that 37 such cases had been reported among 17 million recipients, which is statistically insignificant. Needless to say, the news has been grist to the mill of anti-vacciners and conspiracy theorists from Palm Beach to Copacabana. As of last night, nearly 122 million people have been infected with coronavirus worldwide, and more than 2.7 million people have succumbed to the disease. The United States remains hardest hit, with more than 30.3 million infections and over 550,000 deaths. Brazil, India, Britain, and Russia make up the top 5, and South Africa still has the 16th most recorded cases in the world. Notwithstanding the advent of vaccines and continued measures to contain the spread of the coronavirus, this week saw a concerning rise in new infections in a number of major countries. Brazil is the most serious case, but the situation in Europe is still grave. The resurgence of the virus in India and Iran is also unwelcome news. Despite some notable successes in the war on COVID-19, some 10,000 people are still dying of the virus every day. Brazil has now surpassed the United States as the country with the most fatalities per day. The South American giant is floundering with no clear strategy and its fourth health minister in 13 months. The world's trump card in the struggle against the coronavirus is vaccination. Unfortunately, global socio-economic inequality has also manifested itself in this regard, and so-called vaccine nationalism is rearing its head. Still, impressive progress is being made, with more than 400 million people now having been vaccinated worldwide. The United States is approaching 120 million vaccinations, China 70 million, India 40 million, and Britain 30 million. The United States Federal Reserve is confident that inflation is not about to get out of hand, even though it expects strong GDP growth this year. The European Central Bank is stepping up bond buying to keep yields down, and the Chinese economy is surging ahead. Europe's factories are producing more than expected, and the EU is planning to allow people who are safe to travel again. Meanwhile, Britain's 70,000 Uber drivers have won the right to a minimum wage and employee benefits. The bond market remains wary of inflation. Despite Fed Chairman Powell's reassurance to the contrary, bond yields are pricing in rising inflation and interest rates. US 10-year Treasury yields are now at above 1.7%, a level last seen before the advent of the COVID-19 pandemic. The Chinese economy is on track for robust growth this year, judging by the sharp rises in industrial production, the dark blue line, and retail sales, the light blue line, during January and February. Both numbers were more than 30% higher than during the corresponding 2 months last year. The Baltic Dry Index is the acknowledged global yardstick for shipping freight volumes and therefore the health of global trade. In February, the index reached levels last seen in the third quarter of 2019 and well in excess of pre-pandemic levels. As the index reflects capacity booked in advance, this gives a clear sign that trade will increase over the course of this year. Rising bond yields saw global equity markets retreat this week, and judging by the way hedge funds are dumping bonds, yields could well rise further. China is still accumulating US bonds though, and the US dollar is rising as a consequence. The stronger dollar and softer demand has slowed the rise in the oil price. The Chinese government is trying to crack down on monopolistic behavior by big tech companies, and this is hurting the likes of Alibaba and Tencent. Global equity markets endured a volatile week, with only the Nikkei and Dow Jones registering solid gains. In Johannesburg, the top 40 fared particularly badly, led down by Naspers. For the year to date, the Russell 2000 in New York has now surpassed it, with the Nikkei and Frankfurt's DAX closing in. The main Chinese indices are falling behind, while the Russell 2000 and Nasdaq are the top performers over 1 and 3 years respectively. Over the long term, equity valuations and bond yields are almost always inversely correlated. The recent surge in equity markets, represented by the blue line, was the direct result of massive monetary stimulus, and whether this will continue will largely depend on whether inflation remains subdued, thereby keeping bond yields low. Higher US bond yields have led to a firmer US dollar in recent days, and this has led to commodity prices trending sideways or, in the case of gold, downwards. The notable exception has been the oil price. Despite retreating a little over the past few days, oil is now back to its pre-pandemic levels. We remain positive about global equities, but we expect a continued rotation out of technology to more cyclical sectors. We also expect emerging markets to outperform developed markets, the East, the West, and Europe, the United States. The biggest risk to the equity market is rising bond yields. We remain skeptical about fixed income where yields are still negligible. We worry about the inflation fears that could trigger a fully fledged sell-off. We remain neutral about property, which, whilst cheaper than pure equities and yielding better than bonds, are. People often ask me why I'm so firmly in favor of offshore diversification. The answer has two parts. Firstly, South Africa is small. Our GDP is less than half of 1% of world GDP. The rand is less than 1% of world currency trade volume. The JSE represents less than 1% of global investment opportunities, and many industries that will shape the future are not even represented on our exchange. The second part of my answer is that the world is so big. GDP growth is much faster in many other countries than it is here, mainly thanks to advances in sectors like nanotechnology, artificial intelligence, and sustainable energy. Diversification further reduces risk. The rand over the long term remains structurally weak, and offshore domiciles offer a safe haven in times of political uncertainty. Here at home, there is growing frustration with government's ineffectual vaccination campaign. After more than a month, less than 180,000 people have been vaccinated. That's about the population of Benoni. At this rate, it will take us 18 years to reach Minister Mkhize's goal of vaccinating 40 million South Africans. Tiny Rwanda has managed to vaccinate more people in 3 days than we have in nearly 6 weeks. As of last night, more than 1.5 million South Africans have tested positive for COVID-19, and 51,724 people have succumbed to the disease. Yesterday, 90 new deaths were recorded, and the number of vaccinations administered now stands at 177,275. Experts are concerned that new infections are on the rise again, and that the upcoming long weekends and associated travel could be the start of a third wave. Our balance of payments is in the black, but the rising fuel price could upset this apple cart. Rioting students are demanding that government delivers on its commitment to free tertiary education, and the ban on alcohol sales caused January's retail sales number to slump. Farmers are confident about business prospects, and load shedding is set to continue through the winter. It now seems likely that the British and Irish Lions will not be coming to South Africa, but that 4 instead of 3 tests will be played in the UK and Ireland. Thanks to a huge trade surplus, the current account of our balance of payments was positive in the fourth quarter of 2020, despite the income, services and transfer accounts being in the red. The surplus was the result of a massive decline in manufactured imports, coupled to rises in mining and agricultural exports. The return of economic growth should see imports increasing, however, and the rising oil price won't help either. South Africa is endowed with vast mineral riches and should be enjoying a mining boom. Unlike Australia, the light green line, our mining sector has been in limbo for the past 30 years. Gold output, the dark blue line, has actually declined, and industrial commodity production, the dark green line, has been growing by barely 1.5% per annum. This is due in part to rising production costs, but mainly to a lack of policy certainty. Despite the spectre of expropriation without compensation, South African farmers are upbeat about their prospects. Thanks to good rainfall and bumper crops in recent years, the Agribusiness Confidence Index is currently at its highest level in 7 years. The JSE endured a torrid week thanks to sharp declines in heavyweights Naspers and Prosus. Banks were also under pressure as results disappointed. Bond yields are significantly weaker, but the rand has recovered against the US dollar. Private educator Kuro enrolled more students but still saw earnings decline. On a more positive note, Comair announced that it will be resuming flights to Victoria Falls. The weaker outlook for local bonds led to further foreign selling of government bonds last week. The JSE also suffered a small outflow. For the year to date, the bond exchange has now lost over 28 billion rand, while nearly 9 billion rand in foreign capital has flowed out of the JSE. The rand has endured a roller coaster ride against the US dollar. Earlier this week, the local currency briefly touched 15.50 rand to the rampant greenback, but the dovish remarks by the US Federal Reserve about interest rates have caused the dollar to weaken somewhat. The rand is currently trading at around 14.75 rand to the dollar. Locally, the equity market has been strong so far this year, but valuations are still fair and prospects for earnings growth look promising. Real bond yields remain attractive, but we remain mindful of risks to the fiscal outlook going forward. We continue to avoid listed property and regard cash merely as a liquidity tool because of the low interest rate it offers. The Adviceworx PCS asset allocation view can be summarized as follows. Because of the economy and the weak rand, we remain overweight global equity and underweight South African equity. We remain neutral on global property where valuations are reasonable, but negative on South African property. We hold no global fixed income, and we remain overweight South African bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make sense of them. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworx financial advisor. I hope you'll have a lovely day and a splendid weekend. Until next week, goodbye from me.